SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF BAFFI Bocconi e-lecture on key takeaways from the ECB November 2024 Financial Stability Review. This year marks the 20th anniversary of the ECB's FSR. At the same time, today's e-lecture marks the 10th edition of John Fell presenting key findings from the FSR to the SUERF community. Let me first of all congratulate and thank John Fell and his team for your outstanding work over the past 2 decades and for your very active efforts to disseminate the findings to various audiences, including SUERF's expert audience. Let me say a few words of introduction on the theme. Against the background of mounting geopolitical tensions and structural weaknesses, the euro area economy is facing several challenges. High sovereign debt levels create vulnerabilities and limit fiscal policy scope. Ongoing monetary policy easing in response to a return of inflation towards target has yet to fully filter through to firms' borrowing costs. The industrial and real estate sectors in several countries are in recession, affecting banks' asset quality. While moderating somewhat from multi-year highs, banks' profitability is set to remain above pre-COVID levels, which is a good thing, as reflected in robust capital and liquidity buffers. While private households' consumption restraint puts a drag on growth, their increased saving bolsters financial resilience. Exuberance, concentration, and geopolitical uncertainty render financial markets vulnerable to sudden corrections and bouts of volatility. Non-bank portfolios may face valuation risks. A growing investment fund sector is prone to liquidity, leverage, and concentration risks, entailing risks from fire sales for euro area bond markets. Macroprudential policies need to ensure resilience by further enhancing its tools and scope to better capture non-bank financial intermediaries. So there are many issues out there. What is the ECB's take on them? What is John's take on them? You see major risks out there, and if so, where? We are fortunate to have with us today John Fell, Deputy Director General of Macroprudential Policy and Financial Stability, ECB. John is also a SUERF Fellow. John's presentation will be followed by comments and further inputs by Stefan Avdjiev, Advisor for Financial Stability at the Bank for International Settlements, and Nassira Abbas, Deputy Division Chief at the IMF Monetary and Capital Markets Department. A warm welcome to all of you. Without further ado, over to you, John.
Thanks a lot, Ernest. Thanks a lot for the kind invitation, for the kind introduction, and let me, as always, thank you and the SUERF board for inviting us to share our latest financial stability assessment with the SUERF community. As you said in the intro, this is a special edition for us. It's the 20th anniversary of the ECB's Financial Stability Review. And we have done some extra work in this FSR to explain about what financial stability communication can achieve. I'm going to say a few words about that towards the end of my presentation. But first, I have Jonas Vendelborn here, who's helping me with the navigation of the slides, and he's part of the team. We have a bigger team who produced the FSR on behalf of all of us. I think, and I said it before, and I'll say it again, we really value these opportunities to share our findings. We value the feedback. I'm looking forward to the discussion with Stefan and Nassira, and also from colleagues if we have time for Q&A at the end. We really value the input, and we really value the questions. So let me start with the context and go to the next slide. I think we could say that we've reached a point where uncertainty about election outcomes is mostly resolved. This year, I think, was one of the biggest years in history for elections in democratic countries. It's mostly resolved. It's reduced election uncertainty, but there are other uncertainties that are not resolved. And we know that global trade tensions are on the rise, with concerns that a strengthening of protectionist tendencies across the globe could adversely affect growth, possibly even reignite inflationary pressures. And then added to this, financial markets were subject to several bouts of volatility, the most pronounced occurring in August, and we did think that they were due to some underlying vulnerabilities which haven't gone away. But I mean, explaining maybe three factors that explain three factors that would explain what we think what happened in August. First, as you can see there on the left, economic data released after June tended to disappoint expectations on both sides of the Atlantic. Those disappointments were, as you can see, temporary in the US. It's the yellow line, but they were more lasting and pronounced for the euro area, the blue line. And second, and related to those disappointments in the US, market expectations for interest rate cuts by the Fed went through nothing short of a U-turn in early August as recession fears rose. And then third, geopolitical factors. The list is too long to go through in detail, but that has also contributed. And I think it's also visible there on the right, where we have all measures of policy uncertainty, geopolitical risk above average readings. That chart is showing z-scores. So when it's above 0, it's above average, and then they're standardized by the standard deviation. But you can see there, especially when you look at the index for trade policy uncertainty, it's well above average, statistically speaking. So if we go to the next slide, as you know, our financial stability assessments, the cornerstone for them, they center around sources of risk and vulnerabilities for euro area financial stability. So we're trying to find weaknesses, fault lines that could give rise to financial stability issues. So it's not centered on shocks, but vulnerabilities. And then that tells us whether or not it allows us to have a sense for the shock absorbing capacity of the system. The more vulnerable it is, the less resilient it's going to be to shocks. So our view is that vulnerabilities remain elevated, with three standing out. First, stretched valuations in equity and corporate bond markets, together with high risk concentration, render financial markets susceptible to adverse dynamics. And we think that these could be exacerbated by non-bank financial institution liquidity and leverage vulnerabilities that I've discussed here before. By high risk concentration, I'm going to explain in a little bit more detail later on, but what we mean here that the financial performances of a handful or a handful and a half of well-known single-name firms are now dominating markets. Second, heightened political and geopolitical uncertainty, when combined with weak fiscal fundamentals and also sluggish trend growth, are giving rise to sovereign debt sustainability concerns for some euro area countries. And third, nascent signs of rising credit risk are becoming visible in some segments of the corporate and household sectors, which we think could lead to asset quality headwinds for both banks and for non-bank financial institutions down the road. Now, moving to the first theme, since the summer, financial markets have been what could be characterized as hypersensitive to macroeconomic news. And that was especially news challenging expectations of the much hoped for soft landing. Sentiment waxed and waned, but if we look at investor surveys, for instance, very few are now expecting a US recession. If I put it another way, the vast majority of asset managers are currently positioned for benign outcomes. And that's a situation that we often describe as priced for perfection. And it's visible both in compressed credit risk premia. You can see it there on the left. It's a scatter plot of risk premia on corporate bonds and also equity. You can see that their credit risk premia are close to historical lows, and equity risk premia are at extremely low levels. Now, when market pricing underestimates or possibly even dismisses, so you're putting a very low probability on adverse outcomes, then Since we know that news tends to be normally distributed, we view the underlying vulnerabilities as rendering financial markets more prone than usual to volatility incidents, or worse than what we saw in August, because they're not priced in. And at the same time, the range of potential shocks, so where could shocks come from, we think that they may have broadened because we're now seeing something that I have never seen in a number of decades watching financial markets: firm-specific performances moving markets at an aggregate level. So you can see on the right there that the last earnings report, that's the one before the last one that was published this week, of a US semiconductor firm considered a bellwether for the adoption of artificial intelligence, NVIDIA, was expected to have a larger impact on equity market volatility than the non-farm payroll report, which has always been the biggest market moving piece of economic news in the US, affecting both US markets and euro area markets for that matter. So, I mean, looking at that, you can see the plot over time is getting bigger and bigger. That would tend to suggest to us that if there were a fading of AI, artificial intelligence enthusiasm, that could unravel hard to explain valuations. If we go to the next slide, and particularly striking when you look back at the performance of US equity markets this year has been the unevenness of the rally. I mean, you'll see these very large numbers for the S&P 500. It's up 25% more or less year to date. But if you take a look across all of the stocks that are traded in the US, the median return is about 5%. So there's a very large gap and a skew in the distribution. And the reason is well known. US equity market capitalization is now more concentrated than ever before among the handful and a half of single names, the so-called Magnificent Seven stocks. And it's partly explained by the fundamentals. You can see it there on the left. We've got the concentration. There is also concentration in earnings growth, and earnings growth has been rapid for some of these firms. But still, as concentration increases, it raises questions about the impact that that's going to have, and that's having on market dynamics, especially the capacity of markets to self-correct. Are there participants who will catch the falling knife when asset prices are declining sharply? One wonders, was that part of the reason for why we had such a large correction in August? I'm going to get into that issue in a bit more detail, but I just, why would that matter for the euro area? Well, first, on the left, we're also seeing increasing concentration of exposures of euro area equity funds to those same single names. And then at the same time on the right, and we've discussed this before, although the opportunity costs of holding liquid assets have fallen because interest rates are higher than they were when we had low for long, liquidity vulnerabilities of euro area asset managers haven't improved. In fact, they've even deteriorated somewhat, partly because HQLA valuations declined as interest rates rose. Now, if we go to the next slide, and getting back to that issue of markets' capacity to self-correct. In box 3 of the FSR, we document global passive equity funds net assets surpassing those of active counterparts for the first time in 2023. It's there as the red line on the far left chart. And we think that this is raising fundamental questions about how market efficiency and market stability are being affected. So if you think of it this way, if a smaller and smaller fraction of investors are following the fundamentals of individual firms, how is that affecting price discovery? And then when trend following or momentum strategies push asset prices too far in one direction or the other, and with fewer active investors, will markets still self-correct? Now, empirical analysis carried out by my colleagues shows that as the proportion of passive investment funds rises, and both correlations among stocks and concentration rise. And as these trends continue, vulnerabilities to idiosyncratic risk because of the concentration among single names and markets may be, we think that may make vulnerabilities to idiosyncratic risk greater, and also markets may be more prone to overshooting. And as we saw on the previous slide, euro area asset managers' portfolios are also becoming more concentrated, and that raises spillover or contagion risk. Now we move to the next, to the second theme, sovereign vulnerabilities. It's often said that US Treasury yields are insensitive to the expected ballooning of US debt. It's discussed more and more in the financial press, but this insensitivity, but the chart on the left shows that this is not the case for the euro area. When debt GDP ratios exceed 100%, sovereigns face a premium in refinancing their debts. Now, while the aggregate euro area debt to GDP ratio has declined considerably from its pandemic peak, debt levels remain high in many countries, and that's because of persistence of primary deficits. And it means that fiscal slippage or uncertainty around fiscal consolidation paths could trigger further repricing of sovereign risk. We do now have a new EU fiscal framework, but market participants tell us that the history of compliance with earlier rules doesn't really instill confidence that the new rules will be complied with. And one reason for the skepticism is the 3-decade trend towards political fragmentation in the parliaments of European countries that is shown there on the middle chart. And we know that challenges in forming stable governments can lead to delays, even impasses in reaching agreement on key fiscal and structural reforms. Of course, sometimes maybe it goes in the direction of that the impasse actually could be stability enhancing rather than stability detracting. But I think still overall there is a sense that it moves in the direction of stability detracting, because it generates higher economic policy uncertainty. You see a kind of a long-term negative correlation there in the middle chart. And now with many countries having those large primary deficits, this is going to compound challenges that governments are bound to face in boosting investment to combat all the long-term challenges that lie ahead of us. So greening and digitalizing the economy, defense spending, clearly, and managing demographic change, to name just some. There's a lot of transformation taking place in economies, and public sector investment is going to be required to facilitate it. Now, at the same time, the halving of the aggregate euro area potential growth rate since the 1990s, you can see it there on the right. That, of course, I mean, you know, we were in the EMI together, Ernest. You know the arithmetic for budgetary for debt sustainability. The lower the potential growth rate, the lower the debt that can be carried by GDP. And it's just one of when you make the comparison with the US, it's one of the reasons why markets are less concerned about the risk of an explosive trajectory for US debt than they are for Europe, because potential growth in the US is twice what it is in the euro area. And I think it also underscores, of course, the importance of the Draghi report recommendations as navigating conflicts between stabilizing public finances on the one hand, making necessary investment would be a lot easier if we had higher potential growth. Now, in this vein, going to the next slide, special feature B examines the role that finance has played in the low productivity of euro area firms, and it finds that euro area firms, this shouldn't be new for the kind of audience that joins a call like this, but euro area firms rely heavily on bank lending to satisfy their funding needs. But we're also finding that banks don't seem to have a strong track record in distinguishing between more and less productive firms. I mean, it could be risk aversion. They hesitate in financing risky businesses. Or, we have it in the special feature. It can be especially true when the intensity of intangibles, which, a feature of many startups nowadays, are hard to collateralized assets on their balance sheets is high. Could also mean that they don't have the skills to evaluate unproven or early stage technologies, the kind of skills that you would expect to find in venture capital firms. The upshot is that bank credit has been directed more towards less productive firms. And those are firms in the real estate sector, the wholesale and retail trade sector, and also the construction sector. I mean, the chart in the middle is showing the distribution of corporate loan portfolios and comparing against gross value added of different sectors. And you can see that the sectors that are not generating large gross value added are getting more lending than, if you were assigning credit according to the value that those sectors are creating. But perhaps even more strikingly, when we look at individual sectors, even within sectors, euro area banks systematically lend to less productive firms. You can see it on the right there. The chart is a bit complicated, I know, but it has sectors split by source of finance, bank or non-bank. And we've also got a split of size. So we're trying to show quite a few dimensions in two-dimensional space, but you can see firm productivity is lower across the board for firms relying on bank loans. And the finding doesn't appear to depend on firm size. So you would expect larger firms to be more productive, of course, it's blue dots, but they still tend to be less productive when they're financed with bank loans. Now, it's not a new finding, but I think it offers a further support to the idea that innovative firms would be best served by having access to a range of financing instruments that would be tailored to the business cycle stage of the firm. So not just equity markets, but venture capital markets and kind of everything in between. And I think more generally, it supports the case that a genuine capital markets union, so one that really develops and deepens, integrates equity markets and other markets, would hold potential for boosting the productivity of euro area firms. Otherwise, we might continue to see the most innovative firms in the euro area continuing to list in the US. Now, I've returned to the third and last theme, and it's the next slide, 9. Arguably, a nexus of corporate profitability strength and labor market resilience has been a source, even a pillar of financial stability through the recent interest rate cycle. Profit margins held up, and higher inflation meant, all things equal, that the real cost of servicing debt declined. That spared firms from cost-cutting pressures, which can often result in the shedding of labor. And so firms have, up to now, have remained in pretty good shape, but still interest rate coverage ratios have declined, and it's starting to expose pockets of vulnerabilities in some sectors. And especially sectors that have been exposed to multiple shocks. So say that energy intensive sectors, or sectors which have been hard hit by the Chinese economic slowdown, the German auto sector being a case in point. Now, even though interest rates are now declining, systemic credit events cannot be ruled out, we think, because of the nature of the contracts, the loans. I mean, we know that interest rates are not going to come back to where they started from. And so we're going to continue to get rollover of financing into higher cost debt. Pockets of vulnerability have also been exposed in the commercial property sector, where cyclical headwinds, working from home, the cyclical headwinds have compounded structural ones. So the structural ones being the ones we talked about before, working from home, shopping from home. Now, here too, although conditions have improved as interest rates have been coming down, accidents can't be ruled out. Still, there is, when we look across the non-financial sectors, we think the balance sheets of households are broadly in good shape, and that's thanks to the labor market resilience that I mentioned. We have very low, we have declining unemployment rates, and savings are higher as well. Going to the next slide. I think for now, that nexus of stability explains why non-performing loan ratios are at historical lows on aggregate still, but we're starting to see, you can see there, credit losses on cyclically sensitive loan portfolios. The numbers are very small on the y-axis, as you can see, much lower than what we saw when NPLs were at the peaks that we saw during the euro area sovereign debt and banking crisis. But still, they're starting to turn up, and we're seeing that especially on commercial real estate, SME portfolios, and also consumer lending, not mortgages. The largest contribution is coming from the commercial real estate loan books, but they're relatively modest size. And I think we've shared this assessment before. Because the size is small, we think that mitigates against having a systemic banking sector stress or even crisis coming from CRE, because the exposure are small on the one hand, but on the other hand, there are some concentrations, and it's there where maybe there could still be stress if asset quality, CRE asset quality, were to deteriorate further. The story is a bit different for SME credit quality because it's more contained, but it's also more widespread. And if there were, say, a negative real economy shock, that GDP grows by less than we expect, then we could still see problems there. Now, before wrapping up, and next slide, just a few words on our macroprudential policy messages this time. We're saying these include ensuring that the banks should ensure that capital buffers are set appropriately for the headwinds and uncertainties that lie ahead. Same for borrower-based measures. And then also we think it would be prudent to ensure that the necessary macroprudential space is there if needed, if capital buffers needed to be released, say, in an adverse scenario. Looking further ahead, we see scope to enhance the macroprudential framework for banks. And then looking beyond banking, we're continuing to make the argument that a strengthening of macroprudential policy framework for non-banks would not conflict with, but would rather complement capital market union aspirations, because it would enhance confidence in the financial system. Last but not least, marking the 20th anniversary, as I said, we have an article, next slide, which draws lessons from 2 decades of experience in identifying, analyzing, and communicating about systemic risk. It includes results from a survey of our readers, the majority of whom work in central banks and the financial industry. By the way, we had 86 responses. I'm told for such a survey, it's a specialist survey. It's a decent number. Maybe some people on this webinar participated in the survey. It confirms that there's broad interest in the FSR, in academia, international organizations, the media, and others. Now, just a couple of points on the findings, interpreting some of the findings. When it was launched, we didn't have a macroprudential policy framework in the euro area, and so there was a lot of faith put into the ability of communication as a tool that could be used to inform, to influence, and maybe even prevent financial crisis. And on these basic objectives, certainly the first two, the prevention, of course, it's always hard to say whether you did or not, because you need to see the counterfactual. But the results are positively surprising, because most of our readers say that we have been identifying relevant issues, although some think that we may overstate more often than we understate the relevance of risk, but maybe that's in the nature of the business that we do. And we could be accused of being slightly risk averse. The other, and this is, I think, even more interesting, our readers say that the FSR influences decision making. Now, I would have expected, maybe it has an influence on policy and research, but it seems also to have an impact on risk management, and that's, I think, for us, I mean, that was a nice finding, a nice discovery to make. And then perhaps unsurprisingly, we don't seem to have much influence on investment decisions, but we're not. It's not a report. It's not an investment advisory report. So wrapping up on the next slide, the headline message of the FSR this time is that sources of risk and vulnerability for financial stability have remained elevated since the previous issue. Financial markets and non-banks have proven resilient to recent bouts of volatility. I mean, in the first chart, the first chart I showed, we had a number of bouts of volatility, and we've had resilience. And the fact that it is being proven, it doesn't, in our view, provide any grounds for complacency, because we view the likelihood of tail events in the period ahead as being higher than usual. In this context of elevated macrofinancial and geopolitical certainty, I mean, we can't exclude that there could be a sudden sharp reversal in risk sentiment. And given that we have high asset valuations and concentrated risk exposures in the financial system, there is the possibility, if that were to happen, that the adjustment would be disorderly. And then at the same time, political and policy uncertainties have turned the spotlight back on sovereign risks. And moreover, escalation of, say, military conflicts together with heightened trade policy uncertainty could trigger a weakening of macrofinancial conditions, with the possibility of having adverse repercussions for credit risk, both in financial and non-financial sectors. I'll stop there.
Thank you very much, John, for this excellent overview of key findings of the FSR. I can encourage everyone here in this forum to have a closer look at the report itself. It's really rich and it's a good read. A couple of days ago, we heard that when you started out 20 years ago, the volume was over 200 pages. Now it's just 100. I guess you managed by using smaller.
We changed the font size.
Like in the last slide. No, just kidding. No,
yeah.
I think you really managed to condense it and to focus on key messages, but it's a good read. So encouragement to everybody. It's now my pleasure to hand over to Stefan Avdjiev, advisor for financial stability at the Bank for International Settlements, for your comments. Stefan, over to you. I will share the slides as agreed.
Thank you very much. So I would like to, of course, start by thanking the organizers of SUERF for inviting me to participate in this event, and of course the ECB for producing yet another very comprehensive and thorough financial stability report. The standard disclaimer applies, and we can go to the next slide. All right, so I will not spend too much time summarizing the main messages from the ECB FSR because John did an excellent job presenting them. I'll very briefly go over them, and then I'll try to add what we have to say from a BIS perspective. So the first key takeaway from the ECB FSR is that the balance of macro risks in the euro area has shifted away from concerns about high inflation to fears over growth. And in addition to this, the ECB FSR draws attention to several significant financial stability risks and vulnerabilities in the euro area, starting with financial markets, which are fragile due to a combination of stretched valuations in equity and corporate bond markets, as well as non-bank liquidity and leverage vulnerabilities. The second major bucket of risk, or second major area of concern, is sovereign debt sustainability, which is challenged by heightened policy and geopolitical uncertainty, weak fiscal fundamentals, and sluggish trend growth. And the third one is related to the fact that there are significant credit risk concerns in the corporate and household sectors in many jurisdictions. So we can go to the next slide. So the main risks and vulnerabilities that are highlighted by the ECB FSR are largely in line with those identified by the BS as a part of our global risk surveillance exercise, which we conduct on a regular basis. In line with the assessment of the ECB, we're also very concerned about high indebtedness in both the public and the private sector. Fiscal trajectories pose a very significant risk, and so do elevated debt levels in the private non-financial sector in many jurisdictions. We're also worried about fragilities in financial markets, and we also share the ECB's concern about the cyclical and structural headwinds that are facing the real estate sector. And we are also worried about the fact that the financial buffers in the private sector have been shrinking. On top of the above risks and vulnerabilities, we also think that there are several additional issues that warrant special attention. Of course, many of them related to those vulnerabilities. The first one is related to the fact that financial cycles appear to have peaked in many economies. Another area that concerns us is that the fact that there has been considerable risk migration from regulated financial intermediaries into more opaque parts of the financial system. And we are, last but not least, we're also worried about less visible forms of leverage and broader carry trades, which of course is linked to the financial markets concerns mentioned above. We can go to the next slide. So just again, on the first several, I'll just touch really briefly because again, the ECB FSR does an excellent job of presenting them, and John just did an excellent job summarizing them. But again, as emphasized by the ECB, sovereign debt sustainability is a major concern. Fiscal trajectories pose a very significant risk to macroeconomic and financial stability all over the world. Obviously, not just in the euro area. Public debt is near all-time highs in many countries, and as John noted, fiscal positions are further weakened by heightened policy and geopolitical uncertainty and sluggish growth. We can go to the next one. And as I mentioned a couple of slides ago, we're also worried about the fact that financial buffers of the private sector are shrinking. Even for those households benefiting from large fiscal support, excess savings have run out or have diminished substantially, as illustrated by the left-hand panel on that slide. And non-financial companies will be facing significant maturity walls in the near future, as illustrated by the right-hand panel. We can go to the next one. We also share the concern that the real estate sector is facing headwinds, which are both cyclical and structural. In the residential segment, house price valuations continue to be very stretched, as illustrated by the left-hand panel. And commercial real estate is even more vulnerable, as we all know, both cyclically and structurally. The macro-financial impact of large CRE corrections could be significant. Model-based estimations that colleagues in the BS have done indicate that the response to CRE price shocks could be that CRE negative price shocks could have a material negative impact on both credit and GDP growth, as illustrated by the right-hand panel. We can go to the next slide. So, in addition to those risks and vulnerabilities, which largely rhyme with what's in the ECB FSR, we also think that there are several areas or several additional issues that warrant special attention. And the first one is that, as illustrated in the graph on this slide, there are signs that the financial cycle has peaked, especially in many advanced economies, as credit indicators in real property prices start returning to their long-term trends. BS research has demonstrated that financial cycle peaks are often followed by financial stress within 3 years. Now, the current cycle is still in very early stages of the post-peak phase, but the longer interest rates stay high or get back to being high, the more pressure they'll put on borrowers that need to refinance their debt. And we can go to the next one. Another very concerning trend is associated with risks migrating from regulated financial intermediaries into more opaque corners of the financial system, such as private equity and credit markets. This migration puts at risk the hard-fought benefits of improving regulation, notably in the banking and in the insurance sectors. And there are several trends that are particularly worrisome. The recent rise in banks' capital relief trades needs to be monitored closely. These so-called synthetic risk transfers are tailored to help banks economize on regulatory capital by shifting credit risk to outside investors, such as private credit funds. And when losses on bank loans and mortgages materialize, they will likely pop up outside of the regulatory perimeter. And the ability of those funds and other outside investors to withstand large losses is untested. as of now. Losses could force affected NDFIs to deleverage, propagating risks across the financial system. And then switching to life insurance, their rising reliance on complex reinsurance agreement is another worrisome trend. This form of asset-intensive reinsurance has led to the migration of risk to offshore centers. And again, alternative sources of capital, such as private equity firms, are playing a crucial role in this as investors in insurance companies or facilitators of greater investment by insurance companies in private markets. Overall, these trends imply that risks are being backed by fewer and more risky assets, which is the exact opposite of what regulation intends to achieve. Next slide. So, as stressed in the ECB FSR, there are also significant fragilities in financial markets, which most notably manifested themselves during the stress episode of early August. This episode had signs of familiar amplifiers. Once again, the turbulence erupted because markets had been saturated by leveraged positions with embedded bets on low volatility. And when volatility spiked, it was exacerbated by pro-cyclical deleveraging and margin increases. Now, in this particular case, market functioning did not break down and authorities did not have to intervene to restore calm, and markets recovered relatively quickly. However, we should not take too much comfort from this, as risk-taking in financial markets remains elevated, again, as noted by the ECB FSR. And that is why we should be vigilant, in addition to everything else, about less visible forms of leverage and broader carry trades. So the BIS International Banking Statistics reveal that yen-denominated cross-border lending from Japan via inter-office accounts has doubled since 2021, alongside a persistent depreciation of the yen. And this in turn represents less than half of total yen lending to entities outside of Japan, which also almost doubled during the same period. FX swaps and forward markets are largely off the radar as they're traded over the counter. They are also not treated as debt, but they have an economic function that resembles debt and are crucial in gauging financial conditions. Outstanding notional FX derivatives totaled 104 trillion USD at the end of 2023, which is roughly equivalent to global GDP in 2023 and exceeds global external debt and equity investment. And almost 90% of those involve payment in US dollars. So once again, emphasizing the crucial role of the dollar in that, in yet another example of that. The payment obligations from FX swaps and forwards are huge, but are, as I said, missing in standard statistics. And the much larger FX swap market can be used by the leveraged fund community to bypass funding currency constraints, with the swaps then relatively easily converted into open-ended, into open levered currency bets. Although FX swaps are primarily used as a means to borrow dollars, the August episode illustrated that they obviously their other major currencies play a major role. In that particular case, it was the Japanese yen. But again, there could be other episodes in which other major currencies are involved. Now, BS research shows that prior to the August episode, multi-strategy hedge funds started loading significantly on both the carry trade return and on Japanese equity returns. By some estimates based on the BS OTC derivative statistics, hedge fund positions in yen forwards and swaps were about 30 times bigger than speculative shorts in yen futures. So all of this calls for enhancing the monitoring of synthetic leverage and non-bank activity in derivatives. And as a part of that enhancement push, the BS Committee on the Global Financial System is working to enhance the BS OTC derivative statistics so that they can give us a better glimpse into the sort of questions that I was just talking about on that slide. And I'll stop here.
Thank you very much, Stefan. I don't know, John. I mean, there were quite some additional points. Do you want to comment immediately, maybe, so that we don't accumulate too many? So I have peaking financial cycles, risk migration from regulated to opaque corners of the financial system, and less visible forms of leverage and broader carry trades.
I mean, there was nothing there that we would be, having a different view on. Maybe I would have perhaps, I mean, I saw quickly the chart on financial cycles, which was showing advanced economies a little bit peaking. I think for the euro area, we think that the cycle is a bit further advanced. I don't know what the weight is in that measure for the US. Not sure really the US. I mean, we've gone beyond the peak in the euro area. I think that's one point that I would have picked up. There's also been, I mean, a lot about this narrative of the role that the Japanese yen carry trade played in the August episode. I think it certainly did, in my view, in emerging markets. I'm not so sure that we know so much about the fraction of US, the handful and a half of names that were financed by Japanese yen funding. It might have been there, but I'm not sure that it was really a dominant factor. But it looks like it was, what happened in that part of the market was coincidental rather than caused by, I think. But be interested to hear what Stefan thinks on that. And then I see Gabriel Fagan has a question.
Yes.
Which I could answer. I'd be happy to answer
Please
that
go
one.
ahead.
I mean, I think we see, I mean, it's a great question because it's a theme that is coming up more and more. And I think I'm trying to, can I generalize it and say that we're seeing a lot of this concentration going on in the non-bank rather than the bank space. So, I mean, just rating agencies is a given, but think of ETF providers, market makers, private credit, private equity, crypto, even, in all of those areas, it's a duopoly, or if you can have a triopoly, it's two or three names often, so we have a lot of concentration. And yeah, this is new, the degree of concentration. And I think it's something that we need to work on and better understand. Our box in the FSR this time was a first go at that, to try and answer some of the questions, but I think that there would be other financial stability questions coming from this.
Thank you very much, John, for this first go. Thanks a lot, Stefan, for the first round of very important comments. Let me now hand over to Nassira Abbas, Deputy Division Chief at the IMF Monetary and Capital Markets Department. Nassira, over to you.
Thank you, Ernest. Thanks also for the opportunity to discuss this excellent report and very comprehensive, as Stefan has highlighted too. So in the current environment, I think it's marked by this high level of uncertainty and bouts of volatility, and the insight provided by the ECB Financial Stability Review is very timely and critical in this respect. So first, I want also to commend the ECB team for this fantastic work, and I do know how challenging it is to write such a report in the current environment. So kudos for that. And also let me start by saying that the report's messages and the key findings are really in line with the IMF October GFSR we discussed alongside the annual meetings in October in Washington. So if you go to the next slides, I have a summary of my views, and as also mentioned by Stefan, so disclaimer, it's my own views here. So I think the ECB Financial Stability Review provides a very robust and comprehensive assessment, and the report effectively highlights and elaborates on the shift in risks and spillover effects over the euro area from the external environment. I find that this report goes deeper in these spillover effects compared to the previous reports, and I also think that it's a very crucial aspect, as it also underscores the interconnectedness of global economies and the need for responses to these emerging risks. So I really like the analysis on sovereign vulnerabilities, and we fully share this assessment as well. It's one of the major concerns we highlighted in the GFSR, and it's particularly noteworthy the work that the team has done on this topic. So it provides indeed a very thorough and detailed analysis in light of geopolitical and policy uncertainties. And it provides a very clear understanding of the impact of debt burden on many countries in the euro area. And this is obviously essential for policymakers that navigate these challenging times. So looking at the corporate section, I find also that the report provides a very comprehensive section on the challenges of the sector. And I really enjoyed reading the deep dive analysis on the commercial real estate. And I think the team has done a fantastic job, and the analysis is very invaluable. And the insight into this sector help us to understand the broader economic implication and the specific areas that requires further attention, of course. And the Syria market is also one of the important points we really monitor very closely at the IMF. Regarding the banking sector, I find the analysis really balanced, and so while it highlights really the resilience of the banking sector thanks to these ample capital buffers and liquidity buffers, so the report also rightly calls for caution given the expected deterioration in the asset quality and the moderated profitability given the uncertainty in terms of macroeconomic outlook. If you go to the next slide, I also really appreciated the section on the NBFI sector. So especially that this time, in addition to the liquidity and leverage and concentration risks that we usually cover, the FSR also raises questions and concern about the spillover effects from shocks and volatility in global market, especially from the US. And I think this time, so this section is really very well documented and very insightful as well. So the macroprudential policies. So I really welcome the call for an enhanced toolkit with ex-ante tools to mitigate risk in the NBFI sector, and it's really the way to move forward to build a stronger resilience in the financial system. And I guess this call is very welcome. So obviously, so the report is very comprehensive as I mentioned, and it provides very insightful special features. And happy anniversary to the FSR and to John and the team. And I really wanted to comment the special feature on the ECB framework. And I think through this special feature, we can see how the FSR has adapted to the very fast changing world. And this special feature offers really a snapshot of how priorities have evolved over time. So we also learn how the ECB has expanded the scope of the analysis to have a broader set of factors to capture risk, systemic risk, and the complexity of the financial system, particularly in the NBFI risks, given their increasing role in the global system. So, and obviously the introduction of the macroprudential policy section also reflects well the full ECB mandate and the lesson learned from the global financial crisis. So now, if I turn to the additional issues that may warrant attention or further thoughts for maybe further work in the next reports, let me just focus on the geopolitical and fragmentation risks. So it's another point that actually is covered in the report. So the FSR acknowledges the risks stemming from policy trades and geopolitical fragmentation, but it also indicates that future market resilience cannot be guaranteed given the current headwinds. So this is quite a sobering reminder of the challenges we face. And I'm just wondering, how can the euro area buffer these risks? Can macroprudential tools help addressing or mitigating these risks? This question maybe John can elaborate a little bit and share his thoughts with us. Regarding emerging risk in financial market, I really appreciated the coverage on the AI. So the FSR mentioned the role of AI in the equity market, and in the GFSR we have dedicated chapters, and it focuses also on the role of AI, especially during the recent volatile episodes, and the underlying risks such as cyber threats. There is perhaps potential for future work for the ECB, but also for the IMF, especially given the growing risk of migration of activities to the NBFI sector. So turning to the next slide, there is sections, so the impact of global quantitative tightening on market. So the ECB alluded a little bit to this issue. It's not really developed, but so we do have a concern on our side regarding the quantitative tightening, because coupled with the higher fiscal issuance, it may raise further pressure on sovereign spread. So and also when we look at the market developments, we start to see some friction on some segments in some market, given the transition from collateral scarcity to collateral abundance, while overall liquidity is actually shrinking in the financial system. So more thoughts on the impact of QT maybe could be helpful to understand the ECB stance regarding the impact of QT. And given the ongoing QT raises also the question of the shift in government bond buyers based toward more price-sensitive investors, so may have some pressure, some tension there as well. And also another risk that is alluded in the FSR is the risk of re-emergence of the sovereign bank nexus in this context. Maybe also further thoughts can be shared here. And on the US funding dollar, I really appreciated and comment the authors of this box, because it's an area that we monitor, and we did also a lot of work with the FSB on this topic. So it's clearly an area of concern that we should continue to monitor very closely. And the thorough analysis in this report highlights the interconnectedness among other aspects between banks and non-banks, and the complexity of interlinkages across market. And there is perhaps room to expand further this analysis and to zoom in on the role of the NBFI in the dollar funding, data permitting. And we know that so when we work on the NBFI, there is always this data caps issue, and maybe to conduct also further analysis on the systemic risk associated with dollar shortages. On the mitigation tools, so the author refers to central bank swap lines. So obviously they are a great tool to mitigate shortages, but given the limited access from some market participants, maybe we need to think also about how to address this issue. So moving to the next slide, I would like just maybe to focus quickly on our financial stability report. So the main theme is uncertainty, and this theme resonated a lot during the annual meetings in DC. So indeed, as John mentioned at the very beginning, the combination of this resilient outlook and the soft landish of the global economy combined to the monetary policy action has really supported financial conditions globally, which actually have remained broadly accommodative. And this is what we see in the left chart with the financial index that we use at the IMF. It's really based on pricing only, and there's no balance sheet data in this index. But it shows clearly that since the last report, financial conditions have eased, especially in the US. So the market liquidity, the market volatility, sorry, is particularly subdued. So after the August episode, of course, and it's in a stark contrast to the broader geopolitical and economic uncertainty. And here I just want to draw your attention to the chart on the right, which actually illustrates the difference in historical Z-score between financial market volatility and two other risk factors, economic uncertainty in green and geopolitical risk in red. So as you can see, from 2013 to 2024, the gap between financial volatility and both uncertainty has fluctuated quite significantly, highlighting different drivers of financial market stress. So we can see, for instance, that around the COVID period, financial volatility was higher than economic uncertainty, whereas declines in the recent episode shows that economic uncertainty exceeded financial market volatility. And so the red line shows also geopolitical risk has at times dominated financial volatility, suggesting that external shocks have strongly influenced the markets as well. So this is a short-term concern in terms of the impact and on asset valuation. But besides the short-term risk, we also worried on the medium-term vulnerabilities. And the high level and rapid growth of sovereign debt is a key concern, as also highlighted in the FSR. And also the debt servicing challenges in the corporate sector and the structural challenges in the CRE market are a key concern we also continue to monitor very closely. And so, as I mentioned before, so we also zoom in on the AI advances, and we had a dedicated chapter where we tried to explore the widespread adoption in AI capital markets specifically, and to try to actually highlight the benefits, but also the risks, as the widespread of adoption may also increase fragilities in the financial system. I just want to go to the next slide to zoom in a little bit on the credit risk. We have also a dedicated section, and the FSR provided a very insightful analysis on the commercial real estate. And here I just want to focus on this chart to show you that the market, the commercial real estate is particularly concentrated, especially in the US. I'm showing on the left chart the maturing debt and the funding gaps that holds in the US, Europe, and Asia Pacific. And in the US alone, nearly 1 trillion in CRE debt will mature between 2024 and 2025. And turning the corporate sector, so we fully share the assessment of the ECB. Many firms would find debt servicing very challenging, even if rate cuts and geopolitical events and elevated uncertainty could worsen the situation. So as you can notice in the middle chart, so there is some deterioration in coverage ratios, particularly in Europe, though interest rate coverage are still very high. But it's deteriorating broadly around the world, and the share of the corporate debt with interest rate coverage below 1 is also rising, as you can see on the right chart. So to wrap up, let me just focus on the AI chapter. We covered, as mentioned, the topic and the implication of capital market. The fund does a lot of work on AI, on the macro, on the fiscal, but in the GFSR we really focus and narrow down the scope on capital market. And we actually conducted an outreach with the market participants and supervisors. And what we noticed is that AI is broadly adopted by many financial institutions. However, when we look at the use cases in core investment tasks, we notice that it's pretty nascent, and human in the loop is still preferred. So the chart on the left is the result of our outreach and show that opportunities are seen across asset classes, but so there will still so the interest is still more in the liquid and publicly traded asset, because the high volume of transactions and availability of data enabling AI system to continuously learn and adapt, it provides a competitive advantage. So in terms of the impact on capital market, so the chart on the right focuses on the ETF market, and we look at the different the different aspect of the use of AI, and you can see that the AI-driven investment strategies can lead to higher trading volumes and higher market adjustment speed. And this is illustrated, for example, by the higher portfolio turnover ratio for AI-driven ETFs here. So, so what we notice, we learn from the outreach and the analytical analysis. So it's that AI may reduce some financial stability risk by really enabling superior risk management, deepening market liquidity, improve market monitoring by for both participants and regulators, and it's also enhancing cost efficiency. But then at the same time, it also raises many risks, including market speed and volatility under stress. And obviously, as the ECB has also highlighted, it increases operational risks. So when we ask the market participant if there is a need to get more regulation, so that they said not necessarily, because so the existing regulatory framework actually addresses most of the current concerns, but so it's also expected that the sophistication in AI is going to be evolving, and actually the potential transformative changes of the AI and the impact on the global market should also consider further policy response. So yeah, let me stop here. Thanks.
Thank you very much, Nassira. Again, I would like to give John an immediate opportunity for reactions, and then we also have questions in the chat, which we will then take.
Okay, very conscious of the time. Nassira, thanks a lot. You've clearly gone through it in the FSR in great detail, and I appreciate the feedback on the special feature in particular. And Jonas, who's helping me with the slides, is one of the co-authors, so I'm sure Jonas is happy to hear the feedback as well. Quickly on macroprudential and geopolitical and what I maybe would call binary sources of risk, how to deal with those in the macroprudential framework. It's challenging, it's tricky, because they don't really fit neatly into cyclical sources of risk, let's say, for counter-cyclical capital buffer, or one could imagine that they could be, you could have structural buffers, but maybe the first line of defense on some of these risks is just to assess the idiosyncratic sensitivity of individual institutions to those risks. And so the supervisors, I think, are looking at that, looking at institutions that might be overly exposed to hotspots where these geopolitical risks may be higher, and then I think really for Macropru, it's then to figure out whether there is something, if there is a case over and above what the supervisors are already doing on that. And I think the debate has not been concluded on that topic. On QT, impact on markets, I think one is basic, when we look at the public sector balance sheets in total, we see, increasing supply on the side of sovereigns and decreasing demand on the side of central banks and so on. Yeah, and of course, we have been flagging that for some time, that markets should prepare for that, prepare for the possibilities of bond market sensitivities. We may have seen some of that already, perhaps in the UK. Sensitivity to bad news on market perceived bad news on supply shocks. We're not flagging that the sovereign bank nexus has become an issue again. I think one of the things, we're being careful on this. On the one hand, to not be complacent, that exposures of banks to sovereigns has declined since the crisis that we had 10 years ago. But on the other hand, you can see that there are flare-ups from time to time. One only needs to look at how debt in the bank debt prices yields responded to the election in France earlier this year. It's in there on those shocks that hit markets on the first chart that I showed. We saw outsized moves in say credit spreads on banks in France because of what market participants thought that there might have been the implications for the sovereign debt sustainability and so on. So sensitivity to these things I think is increasing. Just one thing on your gap between uncertainty and volatility. We've talked to risk managers about this, and I think with some of these things, again, it's coming back to these geopolitics, politics, electoral outcomes, binary. And risk managers say that markets are just not good at pricing those kinds of risks. It's one or the other situation, and that in itself might be a reason for why you need some kind of extra layer of, is it a market failure? I don't know, but this is then you have a role for Macropru. Finally, I just like to commend the work on AI. It's great, and I'm really pleased that you're underscoring you're writing a balanced assessment of both the positives and the negatives of AI, because I agree with what you said. I think there's lots of potential from AI to do things more efficiently at lower cost and so on. But of course, we have to be aware that there are also risks. Thanks a lot.
Thank you so much. I would now like to draw your attention to an interesting question that my colleague from Austria, Stefan, put on the chat, which relates to the increasing dominance of ETFs and passive management, and actually asks a very challenging question. Isn't a lot of often short-term investment in passive ETF index trackers actually driven by active professional investors, traders, that express a view, and I add, and actually then drive the indices that then the passive funds are in again? That is the threat from passives to market efficiency really that important, especially when many active fund managers actually hug their benchmark? In this context, I found an attached FT article quite interesting, fun to read, which you might have a look afterwards. May I add two further questions for the final round of comments? One question is addressed to Stefan. You had a slide where you showed on the left-hand side the excess savings, which are already close to depleted. Now, we have a discussion in the European media, in my own country, but also in other countries, which actually have a different flavor, which actually say the European consumer fails to deliver because of continued excessive saving rates, because of all the uncertainty and so on. So how does this chart that you show square with this perception of excessive saving and too low consumption, in other words? And also John pointed out in his presentation and the report that the consumers seem to be, a safe sector this time because of the higher saving. So I see a little bit of a contradiction there. And my second and final question relates actually to the appropriate response of Macropru at this point. Now, I'm aware that this is a sensitive question, but let it put this question in a quite naive way. So I'm a monetary policy guy. So when the business cycle goes down, then what, and the economy is weak, then what monetary policy to stabilize the business cycle would be to loosen. Whereas from John's presentation and from the FSR, I read, okay, we have increased fragilities, several sectors are at more risk. And I understand you rather argue for tightening Macropru. So, building up buffers amounts to tightening that tool. So how do I square this intellectually?
On the one about buffers, what I was trying to do is to give a more global view. And of course, I understand that this is all done within the context of the ECB FSR, but the excess savings starting to get depleted is more of a general statement about the global sort of weighted average, if you will, that it is certainly drifting in that direction. And even if you look at the slide, you could definitely see that even a weighted or unweighted average of the major economies that we have there, or the major jurisdictions, would point in that direction. That being said, the way to square the circle, if you will, which indeed, it is a fact that euro area consumers, as pointed out in the ECB FSR, have been acting in a, I guess we could call it a more prudent manner in that particular case. But you could also even see that to some extent even in that left-hand panel of the chart on that slide, because if you look at the euro area line, it's much closer to the Japan line and much further away from the UK and certainly from the US line, which are, in the case of the US line, already below the starting point, before the COVID starting point. So, and then actually, if I have a half a minute, I could also opine on the other question.
Sure.
On the one on macro and sort of the analogy that you were drawing with monetary policy. Now, and again, this is my personal view, but in the case of macroprudential policy, well, my personal view, which I believe is shared by others who've done work on the issue, that the main goal of macroprudential policy should be intended to minimize financial stability risks and minimize the risks of financial stress in the broader financial system, rather than to manage the financial cycle in an analogous manner to the way monetary policy manages the business cycle. So there could be a positive sort of externality, if you will, in terms of that if you're tightening macroprudential policies, you may end up taming the financial cycle, but that should be a byproduct. And the main goal should be, again, protecting the financial system. So that's my reconciliation, and in that sense, that's the way I think the way to reconcile the fact that there's a calling for a tightening of macroprudential tools at a time when from a monetary policy / business cycle point of view, may have a different prescription, because again, the goal should be to protect the financial system.
Thank you. John, final word.
If I just pick up very quickly on where Stefan finished off, I fully agree with everything that you said, Stefan. I mean, I just maybe one thing that I think is really important, and linking back to, so the ultimate objective is that we want to prevent crises that are going to have costs for growth in these ways where you get a massive contraction because of a financial crisis. I think that's what our ultimate goal is. But going back to what you said, Ernest, just because it looks like Macroprudential is doing something different to what monetary policy would do doesn't mean that it's an inappropriate thing to be doing. I mean, so Stefan, I'm surprised that you didn't mention you had financial cycles. I've done some work with Stefan Farr, but actually inspired by some work at the BIS, that business and financial cycles they're not the same. And in fact, you have financial cycles can be much longer than business cycles. And on account of that, if you're wanting to moderate the financial cycle, there will be moments by definition where you will have conflicts, because those cycles we have a diagram in the paper that I did with Stefan Farr showing that. On the question that the other Stefan Callan mentioned very, very quickly, I agree with the point. Passive can be used for active. You can use ETFs to position for short term. Fully agree with that. Didn't have a chance to read the article from the FT. I'll do it after the call. But I think the point is that we're looking at longer term trends here. I mean, it's like, how are these structural trends affecting? And let me just finish on the savings debate. I mean, of course, excessive saving, you can look at it from a glass half full or a glass half empty point of view. There are buffers there, but it also means that people are not consuming. I mean, I think one thing that's really important, I mean, when you look at these very high savings rates for the euro area and the role potentially the capital markets union could play in the long run. I mean, I've heard it said Europeans are great savers, they're terrible investors in comparison to the US. So you get low savings rates in the US and higher consumption, and US consumers have the best of both worlds. They can save less because they get higher returns on their investments. They're not in low yielding or even zero yielding bank accounts. They're in the equity markets earning 6, 7, 8% as opposed to the 0, 1 or 2 that you get in Europe. So over time, and if you look at compare income but wealth levels between the US and Europe, you see massive differences, even though hardworking Europeans are saving larger fractions of their income they're ending up with less wealth at the end of their, their careers or entering into pensions. Just saying.
Thank you. I see a raised hand by Stefan.
Thank you. Yeah, just to go back and reinforce what John was saying. Yes, definitely on the business cycle versus financial cycle frequency. Yes, as you know, the BS has done a lot of research. If anything, I was a bit too conscious of not being seen as, again, pontificating on the fact that that financial cycles.
It's good work. It's good work.
The very different frequency than business cycles, and again, just to fully agree, not surprisingly fully agree, that you could have the business cycle turning just by virtue of the fact that they're moving at different frequencies, and that the financial cycle is much longer. You could have situations in which the business cycle could be turning down while the financial cycle is still rising.
Thank you very much. This concludes our SUERF BAFFI Bocconi e-lecture on key takeaways from the ECB November 2024 Financial Stability Review. A great thank you to John and your team for this excellent FSR, for explaining it to us, to Stefan and Nassira for your excellent supplementary, very interesting presentations, the vivid discussion, and to all of you, particularly to those who asked questions in the chat, for your interest and for your comments. Bye-bye and take care.
Bye-bye.
Bye.